up, team?
That's right. In today's video, we're going to reveal the number one secret to Warren Buffett's phenomenal investing success over his career. Okay. And how, most importantly, how you can apply it to your own life and your own investments so that you can achieve financial freedom and build the wildest, biggest nest egg you ever dreamed of. That's right, nest egg. We got the props. All right. If you learn Warren Buffett's single greatest and most powerful secret and apply it correctly during your accumulation years, then you are virtually guaranteed success. I don't know where else you can get a claim like that, but virtually guaranteed success by applying this number one principle of his success, okay? But before we do that, we got to get a little bit of context and put this in perspective for you because you got to understand this, okay? So Warren Buffett is the richest investor in history, right, of all time, number one. But he's not actually got the best track record. Now, that's huge. That is the best news for all of us because that means we can apply his number one secret and change our lives. And you can change your family's life for generations to come, okay?
So we're going to take a look at the most common financial game plan, and then we'll get into Warren Buffett's top secret for success.
Right. So I'm going to add this to our stream here. Okay. So we're talking about a financial game plan, right? And how you can win your money game. Now, this is the most common game plan. It might not be yours, but this is the most common game plan. This is the nest egg accumulation plan. And we want to take a look at this here. We're going to focus on the first half before the retirement red zone. Right now, today, we're talking only about asset accumulation and this phase of your lifetime. And this phase could represent from probably most often it's going to be your working years from, let's say, from age 25 to 65, right? Because we kind of generally take age 65 as a retirement age by default. But I want to encourage you, that does not have to be your case. You can retire earlier. It just depends on what game you play and how well you play it, okay? But so focusing on this first phase of the game, we want to look at asset accumulation. And the issue we're talking about here today is the compounding effect of your money, okay? We've got to grow your assets. We've got to grow your account balances so that you've got this nest egg to live on and enjoy the rest of your retirement years. Okay, so what do we got here, baby? What's next? Well, that's our game plan chart.
What is the secret to investing success? It is time.
It is time. Warren Buffett's number one secret to his success is time. That's right. Who would have thought that, right? Time is the greatest. Okay, this is important because we all take this for granted and we don't give it the significance and the weight that it's really due. Time is your single greatest non-renewable asset. And it's non-renewable because once it's gone, the time is gone. You can't ever get it back, okay? So time is your greatest non-renewable asset. And we've got to take that and put it to work for you so that you can get success. And I love this, and I know you say this a lot, right? But we don't know how much time we've got on this earth. We don't know how much time you've got. You don't know how much time you've got, right? We know for sure it's going to come to an end. We're all going to die. But while we're alive, we have no idea how many more days we've got. So every day is a gift.
It is.
And I love that you say that all the time.
It is.
And every day is a gift. And that's why we call it the present. It's a present. It's a gift. Okay. So Warren Buffett is the richest investor of all time. But he's not actually the greatest in terms of annual returns. So while his skill is investing, his secret is time in the market. His secret is the length of time that he's been investing. And that's really the power of compounding. The compounding effect works for all of us. but it depends on how much time we let it work. Okay. So you need more time investing at good rates of return that are consistent, that are uninterrupted, to make this compounding effect work to your advantage. Okay. It's more about your time in the market than it is you trying to time the market. Right? Okay. So here's a short story on Warren Buffett. And we are taking this right from this book right here, The Psychology of Money by Morgan Housel. So good. If you've not read that yet, I want to encourage you to do it. But here's just thank you. Here's a quick summary on the story of Warren Buffett. So it'll encourage you. I'm telling you, this will encourage you and you can apply it to your life. Buffett's fortune isn't due to just being a good investor. Okay. But being a good investor since he was literally a child. All right. In the book, Morgan Housel says that when he wrote the book, he said Buffett's net worth was at $84.5 billion with a B. Okay. But of that, though, 84.2 billion was accumulated after Warren Buffett's 50th birthday. So by far and away, the majority of his wealth was accumulated after he was 50. But the key was that he started when he was 10. All right. That's what's unbelievable. So,
do you know what he started with when he was 10?
I don't.
I know. That'd be
kind of interesting, right? I don't know what he did.
It's in one of his books, I'm sure.
Yeah. Okay. So Warren Buffett is a phenomenal investor, but you miss a key point if you attach all of his success to investment acumen. That's from Morgan Housel. That's not what made him so successful. It's the fact that he has been doing it for like 8 decades. Over 80 years now, he's been investing. He's got 80 years of compounding his money, right? What did we say? The number one secret to his success is time. He's got 80 years of investing his money. So he had started, consider this, if he had started investing in his 30s and retired in his 60s, few people would have heard of him. It would have not been that significant of an issue, in the investment world, because he wouldn't have had as much time to compound the money. Imagine if he got to 60s, a multimillionaire, and he goes, cool, I'm done. I'm going to retire, check out, and go golf, right? Or whatever his, favorite passion was. But he didn't do that. He continued beyond, so he had more time to let those assets compound, okay? And that's what is so phenomenal. He didn't take the phenomenal thing is he started when he was 10. He had all that time. I love the word here Housel uses it, during his pubescence, right? To save money and start accumulating money. The guy was a millionaire by the time he was 30, but he kept investing. He kept growing his wealth and let it compound. But don't miss the fact, over 99% of his wealth was accumulated after age 50, okay? So that's a huge, huge deal. And I love it because it's so encouraging. You and I got the same opportunity. We've got time. Well, maybe, we don't know. But that's why it's so important that you use the time that you do have, because you don't know when it's up.
That's right.
But imagine if you live into your 90s like Warren Buffett so far, and you've practiced investing, disciplined saving every month and investing those assets over that kind of period of time. That's accumulating some serious money. All right, baby, what's up?
Just this quote, if you want to do better as an investor, the single most powerful thing you can do is increase your time horizon. Time is the most powerful force in investing.
Oh, that's it. That's right. Yeah. Warren Buffett's skill was investing, but his number one secret was time. It's time in the market, okay? So to make time work for you and accumulate your biggest nest egg, you have to implement a system of regular saving, okay? And I want to encourage you to implement a system of saving money every time you get a paycheck. We want to make that association. So if it's every Friday or every other Friday or whenever your thing is, build that habit and create that association that when money comes in, money goes right away into your saving.
That's right.
Right? That habit that you need to nurture, you need to work on it, but that habit alone can radically and completely change your financial life over enough time. Okay? Understand this, that just as one paycheck will not make you rich, so you saving every paycheck over enough period of time will certainly make you rich. Right? I mean, it's a mathematical formula, okay? As surely as 2 + 2 = 4, the mathematical certainty of the compounding effect of money, the compounding of interest over enough time will work for you. You just need enough time for it to work. So you don't want to wait. You can't delay because it takes too much time off. You lose compounding or that doubling effect.
Right.
And really, maybe that's the best thing. Compound is kind of like in money, in finance, we talk about the compounding effect or the doubling of money. Maybe you've heard of this. It's called the rule of 72, right? The rule of 72 will tell you how many years it'll take for your money to double. And here it's simple, right? You take 72, divide it by the interest rate or the return rate that you're going to get on that investment. And the answer is how many years it takes for your money to double. So if you earn 7.2% a year return consistently, 72 divided by 7.2% return equals 10. So we know then it'll take 10 years for your money to double. It's pretty simple. This is math. It's not complicated. The complicated part is figuring out how to get 7.2% uninterrupted year after year, okay? So the key variables in this mathematical equation, this a formula for you to achieve financial success and build this big nest egg that you can have financial freedom with, are these. These are the variables, okay? Number one, the most important one is time, the length of time that you've got to accumulate this money. The second most important variable is the amount of money, okay? It's your savings rate. How much money can you save every single pay period, every single month? That's the second most important variable. And then the third most important variable down the road, like doesn't even compare to the first two. The third one is your rate of return. Okay. Now your rate of return must be reduced. It must be adjusted to reflect your tax rate and your interest and fees that you got to pay on that money. And most people don't consider that. Okay. But your real rate of return has got to be reduced by the taxes and your interest and fees for that money. So again, the biggest variables for your success are the length of time. That's number one by a mile, maybe 100 miles. Like we can't overemphasize this.
Right.
Time. Then number two is the amount of money you save. And then a distant third is your net rate of return. Take the gross rate minus your taxes, minus your interest and fees as your net rate of return. That is mathematical formula for success. Okay? What else, baby?
So do not despise small beginnings. The key is to get started with what you have right now and then add more to it every chance you get.
That's right. So the second most important variable, all right, we got Warren Buffett's number one secret is time. The second most important variable is your savings rate. And you control that too. You control the time based on when you start, and you control your savings rate. And the principle, the financial principle, the rule that you want to adopt and leverage in your life is simply this: pay yourself first. Right? If you don't pay yourself, nobody else is gonna, right? So the rule is pay yourself first. And that's in all the personal finance literature. I mean, I don't care who you read. They all talk about that rule, pay yourself first. So that's what we're going to do. And you control that. And that's awesome. You have the power, right? Power of time, start right away. And the power of paying yourself first It's up to you how much you put away, but you can control that. And I want to encourage you, this is the game, right? How much can you put away? What can your savings rate be? Don't settle for the minimum, right? Everybody's talking about putting 10% away. No, that's not going to do it, especially if you didn't get started when you were 10, right? It's not going to do it. So how much can you put away? And that should be your game. Increase your savings rate. How much money can you put away? Okay.
So another financial rule that comes into play too is not how much you make, but how much you keep.
Oh my gosh, I know, that's so good. And that kind of goes to impacting your rate of return, right? How much you keep. So if you're following the first, that rule that we just talked about paying yourself first, you're going to be in a better position. But sadly, most people aren't doing that. What they do is they get their money and they spend everything, and then they save if there's anything left over. That's a disaster, because it's not how much you make, it's how much you keep, right? If you make 10 grand and I make 10 grand, but you spend 12 and I spend 8, I'm way ahead of the game, right? Because I'm saving money and you're going in credit card debt.
Right.
So you don't want that to happen. So how much, the key here is not how much you make, it's how much you keep. And I don't care if you don't make a lot of money. You can be ahead of somebody that makes twice as much money as you because you spend less and can save something.
That's right.
The stats are overwhelming. Like over half of Americans that earn above 100 grand a year are living paycheck to paycheck. They're not saving money. So if you're making less money than that, you can outperform them by saving. It's kind of like the tortoise and the hare situation, right? The hare, the bunny rabbit, takes off and he's all flashy and showy and he's got all this speed and everything and he's spending all his money and he's got the, Louis Vuitton and all this stuff, but he's got no savings, right? And the tortoise is like, yeah, whatever, I'm going to do my thing, but I'm saving money every month and I'm going to let compounding over enough time work for my benefit, and the tortoise wins. Yeah. So I was going to go over, break this, but I don't want to do that. That's the idea, though, is it's not how much you make, it's how much you keep. That's really super important. So one thing I want to say is that maybe we get caught up on the term compounding, because maybe that doesn't mean anything to you, right? Maybe a better term for you to provide a sense of urgency or excitement or passion or something would be exponential growth. And I kind of like that better myself than compounding. I don't know why, but words have meanings and they have feelings behind them and we associate them with stuff. So maybe you'll be more motivated by the impact on your financial future with an exponential growth curve, right? It starts out small, but then over time it shoots up, it takes over. And exponential growth, it's a mathematical formula. You can do the chart, but we think about that also in terms of a contagion or a virus, how it spreads, like it's exponential, right? So maybe that'll be a better way for you to think about time coming to your aid, to your rescue, to your benefit, to your leverage, is exponential growth. And we've got to leverage that. If you're playing this game, the accumulation game, you've got to have exponential growth over time. And I want to just pause here, right? Because we talked about this earlier. Right. Maybe you're over 50 and you've got no money saved. And you're thinking, holy cow, I'm like in trouble, right?
Not out of time, but kind of behind the times.
Yeah. Running behind schedule, right? Yeah. So 2 things. 1, put the power of compounding to work now. Stop waiting. Like everything you've got, start doing it. Change your life. Do whatever you got to do to radically transform and start saving more money every month. And then you can simply extend out the time before you, quote, retire. And maybe you can not retire. I mean, there's plenty of people, successful leaders and business owners and whatever, that they don't stop working at 65, right? Look at Donald Trump, right? The dude's in his late 70s and he's still working. He's still, striving and earning income and making a difference, whether you like it or not. He's still doing it. And he didn't say, oh, I'm done. You know, I'm a billionaire. I'm going to cash out and 65, I'm done. So if you're facing that situation, you're in, good company where you just keep working. You just maybe need to change the nature of your work, because if you're doing physical work or labor that requires, detailed, like maybe if you're a surgeon and you've got to have really steady hand, you get to a point where, as you get older, you don't have that steady hand so much anymore, right? Or if you're doing more physical work, maybe you're a builder, you can't keep doing the physical nature of the business. So you'll find a way to change it and adapt so that you can continue to work, but just not so much on a physical level, so that you can do it longer. Mm-hmm. But we just got to change the game, right? Maybe you start looking at opportunities now more seriously to start building recurring revenue. Mm-hmm. I mean, that's an option.
Right.
Okay. So I just wanted to interject that idea. If you are feeling bad, like you missed out because you don't have the time, we can adjust, right? We change the game plan and we find a way to win. That's right. Because you can win. Mm-hmm. We just got to change the game plan. Okay. Yeah. All right. What else we got here, baby?
The slide. I'm going to show this other illustration.
Okay. Yeah, perfect. Let's take a look at this. All right, let me try to get this a little bit bigger. So we're talking about here is the growth chart. The earlier you start, the bigger your nest egg, right? That's what we're focused on here. And you can start. So we've got these columns: daily investment, monthly investment, 10 years, 20 years, 30, 40, 50. So let's take a look at this. I want to encourage you with this. As you said earlier, don't despise small beginnings. Okay. Right. Small beginnings turn into something big as long as you have enough time. In our example here, we are looking at, $30 per day as your investment. Okay. Which translates to $900 per month. Now, if we follow this chart and time out. This chart assumes a 10% return every year in perpetuity. That is not realistic. We've got to manage our expectations better. And Wall Street has done a phenomenal job of brainwashing all of us into thinking we can earn 10 to 12% a year compounded forever. Okay. Not going to happen. Spoiler alert. I hate to be the bearer of bad news. That's not how it works. Okay. But this is for illustrative purposes only. Mm-hmm. Okay. So understand that we're just trying to show a math formula, right, and what could be, but that's not actually what happens. But if we're half of what happens, that's okay. All right. So let's take a look at this together. So we got $30 a day. We got $900 a month. If you do that, look at this. If you do that for 10 years, $184,360. If you do that for 20 years, uninterrupted, you keep doing it every month for 20 years, that money grows to $683,432. If you do that uninterrupted for 10 more years, so now you're at 30 years of compounding and growing your investment, it grows to $2 million. $2 million, okay? Just putting $900 a month away for 30 years. If you want to retire a millionaire, there's your formula. Mm-hmm. Now, the trick is going to be don't count on the 10% because you can't control that, all right? Build some margin into your life by saving more money than $900 that's required and having the flexibility to go longer if you need to. But that's should encourage you. Oh my gosh, $900 a month at 10% for 30 years. The 30 years is the most important. Grows to $2 million. But look what happens if you can go 10 more years and you can go 40. So let's say you started when you're 20 and you start putting $900 a month away. In 40 years, it's worth how much? $5.69 million. Okay. Now this is ridiculous. If you can go 10 more years, 15.59, $15 million. So Mind-blowing. This is the power of compounding. What if you could go 10 more years? What if you could go 60 years? Let's say you start when you're 10, like Warren Buffett, and you go 60 years. Now you're 70 and you retire with how much? Not 15 million. It'd be more than double. You'd have over $30 million. Is that unbelievable? Guys, this is what's so powerful about the compounding effect of money, okay? And where we lose perspective. It's not today or next week or next year or the next 5 years that's really going to make the difference. The difference is on the back end. We lose that last compounding period. We lose the last doubling. We can't end up with 15 million because we didn't start 50 years ago. We only started 30 years ago. So instead of 15 million, you end up with 2. Yeah, that's right. 20 years made a $13 million difference in your life.
Wow.
Like, it's mind-blowing, right? We don't appreciate time and the compounding effect of money. And I really want to drive this home today. Like, I want to beat this into you so you get the time thing. This is your number one most important priority. All right. What else we got, baby?
Yeah.
Compounding. Yeah, let me touch on this really quick. Compounding doesn't rely or depend so much on earning the highest rates of return. And this is a trap that nearly all of us fall into, and frankly, the trap Wall Street wants us to fall into, is chasing the hottest stock, chasing the hottest mutual fund or ETF. Chasing the highest returns is literally a fool's game. Because we don't want to do that. Because what's the hottest return or stock or whatever this year is not going to be next year. Okay? And if you look, there's research. I love Dalbar's research, and they go through and show you the quantitative analysis of investor behavior over a long period of time. And they've been doing this for over 30 years, I believe. And what they'll show you is that the average investor, do you think you're an average investor? Maybe a little below, a little above, doesn't matter. Their research, their data shows that the average investor does not come anywhere near the market returns over a period of time. And it's because of psychology. It's because of our emotional response to our money, right? So what ends up happening is, instead of buying low and selling high, we're emotional creatures and we do the opposite. We wait until the market's taken off and go, oh man, this one's really doing good. I should get in on it. And then we buy late in the cycle. We buy when the price is high, and then it peaks and it starts coming down, and we go, oh, I'm going to wait until it comes back around before I do anything. And then it goes way down and it bottoms out, and then you go, holy crap, I can't take this anymore. I can't sleep. My partner is all over me about all the money we've lost in our account balance, and I'm not going to be able to retire. The emotion takes over. You lose all discipline, you lose all perspective, and you sell when it's low. And then the market turns and you go, oh yeah, it's probably not going to last. I'm going to wait a little while. And then the market keeps going up and you're going, holy cow, something's happening. The market's returning. And then when you buy in, you're like near the next peak. And so you're too late. So the average investor does not do well because of emotion. It's not because of thinking or reasoning or your intelligence. It's because of your behavior, right? So we've got to understand that and make sure that the compounding is working for you. It's not, the key is not, chasing down the highest returns. The key is getting good returns uninterrupted over a long period of time, which reminds me of Warren Buffett's top 2 rules for investing. Are you ready? Rule number 1, never lose money. And rule number 2, never forget rule number 1. That's right. I love it. It's not, don't be chasing the hottest. No, that's not going to work. That's a fool's game. Put your money to work and earn good returns, uninterrupted, consistently over a long period of time. And that's how you're going to win.
That's right.
Okay. Let's see. I think that was my third variable, right? Was the rate of return.
Mhm.
Number one variable is time. Number two variable is savings rate. How much money can you put away? Number three variable, you can't control it, but you can influence it, is the rate of return. Stop. Don't be chasing. Do not do that. Instead, find ways to get a good rate of return, uninterrupted, consistently over a long period of time, and you'll win. Okay. I hope this was helpful for you. Okay. I'm super excited about going over this game plan and talking about the different parts of it. We're going to be talking more about nest egg next time. Okay. Because
we want a full one.
yes, we do. And what's so important to understand is that what gets you the nest egg is not, what gets you wealthy, what gets you rich is different than what keeps you wealthy or keeps you rich. There is a shift, there is a change. And for a lot of people, the mental, the psychological, the emotional shift that they have to go through, they have a hard time with. But we're going to talk about that a little bit next time. But until then, guys, we are here for you. If you got questions, post them below. We'd love to have you subscribe to the channel so you don't miss any future videos. Definitely give us a like. Let the YouTube algo know that this is a good video and help get this around. But also, we're here to help. I've got a free tool in the description box that you can click on and find out if you're on track for your own retirement. You can enter your personal details, your age and the age you want to retire and how much money you want and all that kind of stuff. And it'll let you know if you're on track or not or what you got to do. And then you and I can talk about it and we can find ways to optimize your plan to make sure that you reach your goal. Okay. But that's all for today.
That's good.
Like I said, I hope you got a lot out of this. We look forward to seeing you on the next video and have a great week.